You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
All right, everybody, welcome back to the podcast. Today, I am thrilled to have Raoul Pal. For you guys who don't know, Raoul is the founder and CEO of Global Macro Investor and also the Real Vision Group. Raoul, thanks for being here.
It's great to be here.
All right, awesome. I've been looking forward to having this conversation for a while. I get to see your work sometimes either through email, you send me some stuff, and then on Twitter and things like that. And I appreciate your global macro perspective. Let's just dive right into the markets. How is it that you start analyzing things? Where does your process begin?
My process begins always with a chart. So on my Bloomberg terminal that I use for my charting and keeping on top of stuff, I have 3 or 4 different pages essentially of one is equity markets, one is bond markets, one is currency markets, one is commodity markets. And then there's a whole page on different stocks and sectors. And what I do is I always start looking through the charts for inspiration to see what stories are being told. I'm a very top-down visual person, so I'm always looking for the story. You know, what can I match up that starts to tell me something that adds granular information? So once I have that it depends how big and long-term those charts are. Maybe updating my view on the dollar over the next few days, or it may be looking at the really big structural thing of where I think the dollar, let's say, is going for the next 5 years. And it depends how large that is and how it fits into my framework. Once I notice something developing, I'll then start digging into my own fundamental research to try and understand what it is that is helping drive price action, or what it is that the charts are showing us that might be happening that the market's not considering. That's where I tend to get the most success, is when I see something in a chart that the market does not have in its narrative, and that tends to drive incredible opportunities. So that's kind of how I look at things.
Well, Raoul, you're preaching to the choir in terms of looking at charts. So you and I have, always seen eye to eye on that front for sure. All right, and then so when you're doing your other sorts of work where you're trying to see what the narrative, what the story is, are you talking like different hedge fund managers and different banks about what they're looking at? Is that how you get to see what the quote unquote narrative is that the chart may or may not be seeing?
No, I mean, I literally don't read anybody else, and I try and avoid talking to as many people as possible. Not because I'm grumpy and unsociable, because I'm paid to have a view. And I'm paid to think independently. So people pay a lot of money for Global Macro Investor, and I also have another retail product called Macro Insiders. I find it disingenuous if I'm reading other people's research to develop my ideas. So I try and think independently, but I do use Twitter, and Twitter is where I can tell the kind of structure of the narrative of what people are thinking, and then in addition, obviously, we can use CFTC positioning and other positioning indicators to try and understand that. But Twitter is where I hear the narrative. So for example, right now, I've been and still remain extremely bullish on the bond markets, particularly in the US. And I hear the narrative building, the drumbeats building of, oh my God, bonds, they're going to reverse, it's going to be this and that. So I hear what that narrative is, but I see a different narrative when I look at the charts, and I know that that's going to tee up potentially to a great opportunity, because I think I can get the risk reward in my favor.
So what do you think? Negative yields for the US? Is that what's coming?
The chart tells me yes, and I can't square this away. So this has happened to me the other day, is I looked at I've been using for a long time what I call the chart of truth, which is the 10-year yield chart. And on Bloomberg, you can do a regression line, and it does the average regression, and it does the 1 and 2 standard deviations, and basically it's traded within 2 standard deviations in this downward sloping channel forever. Now when you look at that, the bottom of that channel suggests that 10-year bonds get to 0 or maybe negative. But when I look at the same for 2-year bonds or Eurodollar futures or 2-year interest rates, it looks like they could go to -4% to get to the bottom of the channel. And that's not my prediction, but like you, when I see something in a chart like that, it makes me go, huh, that is not the narrative. The narrative is either the Fed aren't going to do much, this is a mid-cycle event, or it can never happen in the US, or rates are going up, everybody's got it wrong. Those are the three narratives. There is almost nobody with the narrative of, oh no, everybody's got it wrong. The actual, the actual kind of tail of the distribution that's most likely to happen is that rates in the US go massively negative. So that's something interesting to me, and that's how I think about it. So my view is shifting towards, my prediction for a long time was US 10 years get to 0.5%. I'm now starting to think they go negative.
All right. Well, you're a smart guy. You know that the most important thing in what we do is risk management. So let me push back. What would you need to see for you to say, you know what? Maybe I got this one wrong, and maybe rates are going higher, and we need to be selling bonds, not buying them. What would need to happen for you to change your mind?
So there's two ways that can happen. Three ways. Obviously, growth could suddenly miraculously return, which I do not see, and I don't think that is a high probability. I do a lot of fundamental research on the business cycle using stuff like ISM or the ECRI and a whole bunch of stuff. I don't see that happening. So then can somebody force a change? And that would be, let's say, an enormous fiscal stimulus from China or the US or Europe. That looks like it is not possible yet. The US election is probably the only time we could get something closer to that. But I think we have to see something worse first. And the other one is the dollar breaking down. Now, this is the big debate, even amongst chartists, is what the dollar pattern is. My view is that I think the dollar goes up exponentially, which is not consistent with many people's view on this. And the dollar's complicated to chart because the DXY is not a perfect gauge of the dollar because it's very euro weighted. Yeah. If you look at a bunch of individual currencies, whether it's the Chinese RMB, whether it's the euro its own right, or whether it's the Aussie dollar, some of these have got enormous chart patterns. And when I look at the Asian currencies, like using the Asian DXY, the ADXY, which you get on Bloomberg, it's probably got the biggest head and shoulders top I've ever seen in the history of the currency market. So there is something, I think, really big brewing. I think most technical analysts in the FX world are not looking at those very big charts. They're looking at one phase less. But I understand it is not a definitive, I'm seeing it right and nobody else is. But I am tilting more towards that. But I do understand that this could be wrong. This is a very strong opinion of mine, weakly held.
Yeah, always though, right? What about, like, you look at a trade weighted dollar index that's making all-time highs? I mean, if you just
Correct.
show the trade weighted dollar index to any technical analyst and you don't tell them what it is, what are they going to say?
Yeah, it's clearly a massive cup and handle formation going a lot higher. Same with the RMB in China, same with the Brazilian real. It's difficult to argue with that stuff, but people will argue because the dollar's one of these things like gold that people put an emotive opinion on before an actual opinion. And yeah. The reason being is it's really difficult to know what drives currencies. People say, oh no, because the Fed are going to cut rates, therefore the dollar's going down. Well, it doesn't work that way. It has what's called a Bayesian distribution, which means that it's a multi-factor variant that affects the price of the currency. It's not like bonds, which are basically forward-looking. Where's GDP going? What's inflation doing? It's much easier to forecast bonds, which is why I love trading bonds at this part of the cycle.
Yeah, I have a question for you. So you look at, let's just say the dollar index, right? Dollar index, let's just call it flat for the year, right? Up slightly year to date. Really, it's just been a mess, right? It's just been a sideways grind. Gold has absolutely ripped in that environment. If you would have told me coming into the year that gold would be doing what it's doing, I would have told you the dollar would be getting crushed, right? So is it the resiliency of the dollar in the face of gold ripping, or should we be impressed by gold doing so well without the dollar falling?
What you need to understand is what is the narrative the market's telling you versus what everybody wants to tell you the narrative is. Because gold people are like the kind of anti-dollar crowd. They are the anti-dollar crowd, is they have their own narrative. So I ignore that. What is going on is when you look at the price of gold and look at the correlation to US treasuries, they're extremely highly correlated. Why is that? Well, then when you look at the chart of gold versus the chart of negative yielding bonds globally, they're highly correlated.
Yeah.
So basically what it's telling us is as interest rates fall, gold is going up. Firstly, because it has a very small cost of carry. The cost of storage of gold is pretty low. And then other than that, you can't have a negative interest rate on it. So it protects you from negative interest rates. I get it. So gold becomes quite attractive. But also, what are the falling interest rates in Europe telling you, or the Japanese interest rates? They're telling you that we're getting to the end of a central bank's ability to manage an economy via interest rates, which is something that many of us in the macro world have looked at for a long time, not knowing how it's going to end. Right. What we do know is somewhere within this equation will be an attempt of modern monetary theory, which would be excessive fiscal spending and trying to finance it via debt, which is bought by the central bank. So there will be more debt and more printing of money. Or there'll be a situation which is likely to happen in Japan before anywhere else, where the central bank has to buy all of the debt of the government and write it off, called a debt jubilee. So gold is acting like an option on all of these outcomes. And I've always said, I've been saying for the last 4 years, is the latter part of this business cycle, gold and the dollar will both explode higher. And eventually the last man standing will be gold. And that's what's going on.
And in the face of all of this, and a strong yen, if you want to throw that wrench into the equation as well, so sort of like a flight to safety sort of trade between the bonds doing well, gold doing well, yen, all of these things, you got the U.S. indexes a stone's throw away from all-time highs. Is this the last grasp before everything all falls apart, or should we be impressed with that sort of resiliency?
I always look at your comments on Twitter with interest on this kind of stuff, and you're dead right in what you say. And you're basically saying the same thing that I say on the dollar, which is stop putting your personal opinion into it. Look at what's happening. So my personal opinion would be that equities are overvalued, blah, 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 but they're trading okay at top level. Now, what is interesting is when you start digging in beneath it, as you'll know, is the leadership and the strength of the rally is actually fading as many of the more cyclical sectors are falling apart. Also, the structure of the markets themselves, they don't look great, but I don't see the great risk reward in shorting or buying equity markets right now. So I try and keep away until I get a better technical signal or I get a better economic signal. What I do know is the probability of equities falling when the ISM is crossing 50 on the downside and moving lower goes up extremely fast. So if we continue to see the business cycle weaken, it would be almost unheard of for the equity market not to fall significantly, and we're talking 20% or more. Can that not happen this time because of other reasons? Sure, and the charts will tell us the truth. What's your view on it?
I think that you're smart to, with the conclusion of I don't see a good risk reward on the short side or the long side, right? And that's wise because it's been a hot mess for almost 20 months now, right? So, if there hasn't been, so that's nothing new. So you, as somebody who looks for trends, myself included, we look for trends, and the trend has been this is a sideways market. I'd push back on the leadership. You're talking about defensive leadership and weakening leadership, and who's making all-time highs? Utilities, staples, real estate investment trust, things that pay high yields. Maybe that's a defensive trade. Maybe that's an interest rate sort of scenario that, keeps a bid on those sorts of high dividend paying stocks. both stories make sense. But I would push back that that's not just the leadership. You're seeing technology making all-time highs. You're seeing consumer discretionary up there as well. You're seeing the new communication sector. I would be arguing that those are not defensive sectors at all. And in fact, these are some of the most important and biggest sectors in America. So I struggle with the defensive weakening leadership. I'm just not on that side.
I think you're probably right. The only thing that I observe is that I was actively involved in the top in 2000, 2001. It was bloody similar to this, which is increasing volatility of the equity market overall, no clear price direction, and internals that were barbell. So, if you remember towards the back end of the 99, 2000, 2001 top, the utilities and the Dow Jones transports, everything else took off for a period of time. The utilities and stuff all took off. All the defensive sectors took off, but technology kept going as well. And I'm noting that. And again, it's not. I'm only noting it. I'm not taking any action because of it. So I would interpret that as, okay, that's interesting. I'm not sure whether it's strength or not. And maybe that's what the market's telling us. Maybe the choppy sideways market is actually telling us, yeah, you've got a bifurcated market here where the continuing leadership still goes up, the middle tier goes nowhere, and then the defensive sector is going up as well. I mean, maybe that's the right thing to do if you're an equity manager right now, is you own the racy stuff and own the safe stuff.
Yeah, I mean, listen, you could be in the camp that we're in a vicious bear market if you are overweight energy. Yeah, you think this is the worst market ever. But if you've been in technology or even like in the healthcare space, yeah, if you've been in pharma and biotech, like you're struggling. But if you've been in medical device stocks, you're doing great. If you've been in some of these mobile payment stocks, right, as opposed to the banks, you're doing great. So there's some stuff that's working. There's some stuff that's not working. And what's wrong with that?
Yeah, I totally agree. Which is why through this whole process of global growth slowing down, I've said there is one trade that beats all trades for me. And it's been probably one of my most successful calls I've ever made in my entire career, has been this Eurodollar bond trade. So I started with bonds and then eventually moved to the short end of the curve. And that trade has been a phenomenal success because experience taught me what happens to the curve, not to the curve, to bond yields and how to trade them when you're in a more serious longer term slowdown. And that the equity trade, volatility adjusted or anything else, is just not good. Even the commodity trade is not great. Sure, eventually you were able to short copper, but even oil's been a sloppy mess. But the bond trade, now that's a beautiful, low volatility, trending market. It's like a gift from the gods. And that happens every time we go into a Fed easing cycle. It looks like that. And as long as you've got the conviction from your fundamental view that you're going towards recession, I think, interest rates, we're going to aim for zero. So if we aim for zero, we've got plenty of juice to come, and that low volatility catapult higher is probably the most attractive risk-reward trades that ever come by.
You briefly mentioned copper, and if you're going to be right on the dollar and your call on interest rates, I'd imagine we have falling copper prices in that environment, right? Would you agree?
Yeah, absolutely.
So, you look at, I don't know if you look at commitment of traders, the way they're positioned. I mean, commercial hedgers have historic long positions in the highest, biggest ever in copper. Specs are incredibly net short. You could look at copper over the last few years, just see a classic head and shoulders top, I suppose, if you want to call it that. If copper collapses, these commercial hedgers are wrong. But if the commercial hedgers got it right, this is not a massive head and shoulders top in copper. In fact, it's just a sideways grind, and now we're about to rip. Emerging markets are going to do very well in that environment, and I'd imagine it's the dollar that's falling in that sort of period. Would you agree?
100% right. I, on the other hand, don't think that that's how it's going to play out, but I absolutely live in fear of that playing out that way. And that would be the reverse of what I'm thinking. The dollar weakens, commodities rip higher. The kind of wedge pattern that I'm seeing in oil resolves itself to the upside. copper, this ends up being not a head and shoulders top, but some sort of, triangle or whatever, and it goes higher. The world is fine, everything's fine. My bond trade is, I'd have to, stop myself out in the bond trade, having made a lot of profits in it. Fine, that's how the world works. That's what happened in 2016. I don't think it repeats.
It's interesting you bring it back to 2016. I remember in 2015, I was the end of the world guy. I'm like, oh, Deutsche Bank's going to zero, world's coming to an end. And then things dramatically changed in January when emerging markets bottomed in January. And then it wasn't until February that Europe and Japan and US put in their bottoms. But that relative strength in emerging markets, for me, had to be at least cyclically bullish for sure for a trade. I was under the impression that it was just a counter trend move. We were going to roll over, make new lows, and the world was going to fall apart. And it wasn't until that summer that I changed my mind. I was like, oh my God, not only are we not falling apart, we need to buy everything. And it was really in part because technology was really breaking out on a relative basis and absolute. Industrials were getting bid, the railroads. This is before regional banks started getting going, but continued renewed strength out of emerging markets. So I had to change my mind, turn bullish, and fortunately that worked out really well. And some of my associates and I, we've been comparing the current environment to that period because of the underperformance of small caps and transports throughout the summer. If we get that rotation, we retested the early June lows in transports and small caps, and we get going from here. I think we need to err on higher prices, right? That's sort of how I see it. You're saying that it's not going to be 2016 over again. It's going to be different this time.
No, because I note a behavioural bias that happens from a recency bias in behaviour, which is when you've seen something fail, you become scared that it's going to happen again. And so there is many people. I mean, I was in the apocalyptical camp at that point and made a lot of money trading dollars and shorting oil, because that's when I made the call when oil was 120 that it was going to $30, and it did, which was, I don't know how I managed to manage that, but that was what the chart told me. But I thought that it was going to follow through and we were going to go into full recession. We didn't. We got saved by the Chinese stimulus. So I'm looking at this from a multifaceted viewpoint. Do I see anything, going back to a question you had earlier, anything in the picture that changes my outcomes? And I don't see it yet. But I do live in fear of 2016. But I just don't think it's that case. I think everybody thinks it's that case, which is why everybody wants to sell bonds, everybody wants to sell the dollar. And I just think that the risk is skewed the other way, and I still remain of that view.
Do you get any, you look at Twitter and stuff like that, so you try to gather, you've probably gotten really good at it as I have as well, is try to gauge the way the streams are, right? But what about from a more quantitative standpoint? Do you look at, the polls and other sentiment data as well?
No, I look at positioning, and I look at positioning it is a lower order of magnitude interest to me. I basically, because I'm a longer term guy, so I'm looking at how structurally long or short people are. So I'm looking, for example, at the 2-year notes, and I noticed the market's the second all-time short they've ever been again, and they're short 10 years. And yes, they're very long Eurodollars, but not in the order of magnitude that they were short Eurodollars recently. They were short 4 million Eurodollar contracts. They're now long 2 million. So I don't think we're even close. So I just look at it from that as a heads up, as I'm just trying to avoid screwing up or looking for turning points. So the turning point for me when I nailed oil was based on that, and nailing the bond market was based on that, the record short position in the bond markets across the curve. It doesn't always work either, as you know. We all make a lot of wrong calls too. But I just use it as contextualization, but I don't use it as I will never trade anything based on positioning. I know a lot of people do, and I just don't do it.
Yeah, it's just one input for sure. You mentioned making bad decisions, and the best way that I've always learned things is by learning the lessons the hard way, and having to keep getting punched in the face until I say, you know what, maybe I should get out of the way this time. And until you finally learn that, you don't really get it. What was that moment for you where you realized risk management was the most important thing in the world? Was it a bad mistake? Was it did you watch somebody else make a bad mistake? What was it?
Two things. One is, when I was running a large global macro hedge fund, you learn it pretty quick. You learn first, and I've learned a lot of lessons. My first lesson I learned, because I came from being a salesman to running a global macro portfolio to then starting a hedge fund and then running that. But I remember one of the trades I put on was somebody, a seductive salesman, calls me up. I think it was from Morgan Stanley at the time, and he was a famous guy. Calls me up, goes, "Hey, you should be doing this trade. It's long, short semis, long Nasdaq, or whatever it was. I can't remember what the trade was." And it was not macro trade for me. I didn't really understand the trade, but I just wanted to look like the guy, and I wanted to be involved in something. And the chart looked all right to me. And the next day, the Fed cut rates, I think, or no, whatever it was, the Fed made some announcement. This was in the 2001 recession, just coming towards it, that thrashing around period before the market topped, and that bloody thing moved 15% in one day against me, and I had a way too big a position on. And that taught me, don't do trades you don't know anything about. Just don't do trades for the sake of doing trades. And secondly, understand what the actual underlying volatility of what you're trading is, so you know where to set stop losses and therefore size a trade. So trade sizing, I learned by stop loss setting and not using any other way of doing it, and just looking at the natural order of volatility of a particular thing. The other thing that I never forget is it was January 2002 or three maybe, and I was up on the global macro hedge fund. I was up maybe 8% in a month, so we were having a huge month, and we were starting to press our bets and I was starting to believe that my shit smelt of roses. And my boss came to me and said, "You've had a great year, Raoul," and walked away. And what he was saying, I didn't listen to. I was like, "Yeah, how funny." I'm like, he was saying, "You could just take some money off the table and you would have had a great year." And I just ignored it. I thought, yeah, no, I'm in the hot spot. Well, the hot spots go away quickly. If you're taking that much risk that you make 8% in a month, you need to be really, really cognizant of that risk. And sure enough, I gave it all back the next month. It's like, really? While I could have taken up half the profits, given back 4% back, and been up 4% on the year, and I'd have been doing it well. So learning that was another big thing. And then the biggest lesson I learned was 2009. My emotive side thought that things were going to go further than expected on that we really could see a total shutting down of the system. My analysis told me that the ISM had bottomed, and I used the ISM as one of the business cycle as the key driver of prices, and then I was making the assumption that the ISM was going to roll over again, which would be an extremely rare event. It's only happened once in history, but I bet on that event and stayed short, and then gave back a ton of money because I'd had a phenomenal 2005, 6, 7, 8, and then 2009 I really totally screwed up. So that was me not listening to my own analysis, and I've learned subsequently to be more careful. So 2013 came along, 12 came along, 12 and 13, when Europe almost blew up, and I nailed that trade, and then it started moving against my core view, and eventually I closed it out and I was flat, having had an extremely strong view, and it went against me. That was fine. I don't mind a flat outcome from something like that where it didn't work out in my favor. And then 2016, where we talked about, I ended up on the year. So I've learned those lessons, I think. I hope. There'll be other lessons to learn, but there's a lot of them to learn.
I'm glad that you talked about like where you got it wrong and then how that helped you in the future, right? And helped you not make that mistake again. For me in 2008, it was my first real bear market, right? Because I got into the business in 2003. So for me, I couldn't have been more excited, and fortunately we were bearish early, but it was really hard for me. I struggled. It was the first time that I had ever had like really aggressive short positions on, and I'm literally hoping that the world ends. It's like, oh, this company's out of business and all these people lost their job. Great. unemployment, just rooting for bad news was really, I definitely struggled with that, but it helped me in 2016 when everybody was pessimistic and I was super optimistic and everyone's betting on, hoping for terrible things. And I'm like, I don't know what everyone's so angry about. We need to be buying everything. And if it wasn't for that 2008 experience, I don't know that I would have been able to have been as successful in 2016.
Yeah, but you have to be careful of your own behavioral bias.
Yeah.
So we all carry an inherent bias, and because of the nature of the markets that you've been involved in, you will be naturally a bull. Because of the nature of walking into my career, I started in 1990. That was a recession. That was my first point of reference. The second point of reference is I learned about options and was doing an option simulation course in September 1992 and I was trading FX options when Sterling left the ERM and had the enormous move where George Soros made $1 billion, and I made the biggest ever loss in the history of the trading course, theoretical loss. Then it was 1994 and the bond market blew up. Then it was 1997, 98 and the Asian crisis. Then it was 2000 and the tech bust. So mine was peppered by really big macro events. So it meant that my bias is towards making outsized returns in the downside. And that is people like Stan Druckenmiller, Paul Tudor Jones, they're all skewed that way because, as you know, a bull market goes up for 10 years slowly. A bear market does all of its action in 18 months.
Yeah.
So if you get it right, you make an enormous amount of money. So it becomes intellectually more interesting to look for those events. If you can make money in the bull markets as well, then you've half won the game. And that's trying to avoid, even though you have a bias, it's trying to avoid your bias taking over. And I've got friends of mine who've been trying to short the equity market literally for 10 years now because they're so biased to the short side. And I'm like, you can express that in different ways. You can avoid the US equity market and be long. India was a trade that you and I liked for a long time, right? Yeah. And that gives you don't have to have the emotional baggage of not liking the S&P. You can like the future of India. So, it's stuff like that I use as tricks to get around my own behavioral biases.
That's good advice. And yeah, I mean, you watch these guys just so, at least you're aware that you have this like struggle with being optimistic and you're aware of it and you figure out ways to not get involved. Like you talked about staying away from the equities market, right? That's wise of you. Others, it's good that we're having this conversation because it's good for others to hear, like get around it, be aware of what you're thinking, right?
Find things you're bullish on, right? I am not bullish on developed markets for a whole bunch of structural issues that I've spent 20 years working on. But at some point in the business cycle, when the business cycle is expanding, you need to own equities. So get over it and find where you want to own equities. And if you find different markets, I tend to prefer emerging markets and frontier markets in that kind of part of the cycle. Great. And I can then be a full-blown optimist because I don't have to have the baggage, and that really helps. And this is the problem the bond market's having right now. Almost anybody who trades bonds has a bias towards inflation, and that's why they absolutely struggle with remaining long bonds because they always think inflation is going to come out of the cupboard. I'm the opposite. I just think deflation is coming out of the cupboard because I just look at the trend over the last 30 years. But many of those have, if you're a bond market trader, the biggest event you had was 1994, the risk blow up, and then looking back in history saying, oh my God, look what happened in the late 70s. So it's behavioral biases. It's just a key thing. And you've got it. I can hear it in your voice. I see it in your Twitter feed. You've got a behavioral bias.
Oh yeah, I have a lot of different biases for sure, and I try to talk to my friend Phil Perlman about it constantly, and I'm always working on it. And I got to tell you, I've come a long way to being open-minded. I've seen plenty of cycles up and down before, so I've come a long way, and I've come long enough to realize that I still have a long way to go.
What's fascinating, JC, is seeing the Bitcoin crowd learn all of this from you. right? Because there is no, they came into this not knowing anything about financial markets or how assets trade.
Mhm.
So we all have history. We can look at the history of IBM for basically 50 years, or we can look at currency market. But when you started with Bitcoin, there was nothing to learn from. So I'm watching people learn and go through their behavioral biases and what they did and how they affect it. It's just super interesting. It's like a real-time experiment in people learning. But what has been interesting is how many of those guys have gravitated towards technical analysis.
Well, there's no earnings, Raoul. There's no companies. There's no fundamentals. What's the fundamentals? You know?
Yeah, I don't agree. I think there are fundamentals, but it's more to do with the commodity. It's more like trading gold, or it's more, there are different ways, and it's a very complicated and complex thing, the whole Bitcoin world, and it's not a straightforward asset price, but it does chart beautifully.
There's no question that it is an incredible expression of human behavior and emotions. I mean, and particularly because, the big institutions can't bother with it because the market's too small. So it's basically just a beautiful expression of retail investors all over the world, just fighting with one another. I mean, it's really amazing to watch. The way you said it before, it's like a live experiment. I mean, you couldn't be more right.
And what's incredible to me is it is sucking in, and forget all of the intellectualization of Bitcoin and all of that stuff, but it is attracting some of the greatest fund managers I know are moving entirely into that space. They're like, this is the biggest opportunity I've ever seen. And also because it trades like an instrument that people knew from the past. It seems to have that movement, that fluidity, that response to charts, that human behavior that is more familiar with some people, or the kind of markets that people have always dreamed of, which is why, it's worked for the kind of momentum crowd, it's worked for shorter term traders, it's worked for the kind of algo crowd, and it's worked for technical analysts. And I think the technical analysis has been just simply incredible on Bitcoin. And I know people like Peter Brand has done a great job of that as well.
Yeah, we see it all the time. I mean, we see some really bad charts on the cryptocurrencies, of course. A lot of chart crimes. If you're looking for chart crimes, that group is a great place to find it. But yeah, 100%. People doing great work.
That's an interesting one. So I wrote a Twitter post, and I've been doing. I first started in this business training people on technical analysis, and I have been a technical analyst my entire 28-year career and 29-year career. And I put a post on Bitcoin on Twitter recently that I said, look, I think this is a wedge. I use the word wedge as just a triangle-ish formation pattern. Yeah. And I said, I think it's going to break higher. And I got, interesting enough, the audience had got themselves, the Bitcoin guys had got themselves all bearish. But the other thing was this technical analysis, pedantic chart crime Twitter, where I got like literally 300 messages going, well, that's not a triangle, or that's not a wedge, or it's like, listen, guys, get over it. You don't have to be pure. It's what works for you in putting probability in your favor. Call it what you want, exactly. I'm not, and again, I've been using charts for 30 years. It's not like, it makes me laugh. I was, the guy who does my analysis, BMI, he's not a good chartist. So I'm like, no, you need to draw a trend line here and there. So there's people who don't know how to draw a trend line or do a chart. There's others who just interpret charts in their own way, and we all, in the end, develop our own style.
There's no doubt about it. And before I let you run, I wanted to touch on Real Vision. You have a lot of technical analysis on there. I see a lot of my friends. I'm there all the time. Tom Bruni's on there, and a bunch of my other friends as well. I see, is there a bigger focus on technical analysis on Real Vision, you think? Or is that just my bias and that's who I get to catch the most?
Yes, more than you see in mainstream media, just because we are more practitioners. And, Real Vision was probably born out of macro, and every macro guy I've ever known starts with a chart.
Yeah.
So I think It just so happened that it's that way, and it's so there is a lot of technical analysis on it, and a lot of people use it within more, bigger picture frameworks of stuff. So, we don't shy away from it. We don't hold any judgment to anybody. We just acknowledge that it works for an enormous amount of people.
And then Real Vision just turned 5. I know you're the founder or one of the founders. Where did that idea come from?
That's interesting. Yeah, it's just turned 5, and the idea came from 2008, when I was one of the people who kind of predicted what was going to happen, and it got really bloody ugly. And then 2012 in Europe, and I was living in Spain at the time, was really ugly. I mean, friends of mine, their bank accounts were being seized, and all sorts of bad things were going on. We were about to lose the banking system, and people came to me. Friends of my parents and friends of friends said, why didn't we know? And a lot of people lost a lot of money. And I'm like, let me think about that. Now, I understand the banks can't tell the truth. If they were going bankrupt, the last thing they can say is we're going bankrupt. But the media let everybody down. And we just thought there is a better job. And I also thought, I don't like the fact that all this information is elite. So if you're a top hedge fund manager, you get the information, but the average guy, he doesn't get it. It's like, this is not fair. We can democratize this, and I know all of these guys, and I can speak to these guys, and we can bring them on the Real Vision, and everybody can learn from the world's most famous investors. And so that's what it started as. We had no idea what we were doing, but we did know that if we were to open the minds of the greatest investors in the world and give them to people at a reasonable price, everybody's going to benefit. But boy, we didn't realize how engaging people would find it. I mean, it's gone from being cults to now everybody's essential viewing, and it's become a centerpiece for our entire financial community, where everybody appears in it, from the world's most famous hedge fund managers to new up and coming guys, to the cryptocurrency guys, to the gold guys, and everybody has a place within it where they have a freedom of expression. As long as they produce quality work, we'll have them on Real Vision. As long as they have, respect within the community, we'll have them on Real Vision. And so it's been an extraordinary thing. And actually, there's a new thing we've just done is, if anybody's listening to this and they haven't checked out Real Vision yet, is we've even got a free version. So you can either find us on YouTube, or a really easy one is realvision.com/free. And there's a free version of that gives you about 20 or 30% of the content of Real Vision, just so people, again, to democratize it, we want as many people as possible to engage with it. So they should go and check it out. And look, even if you end up subscribing, it's $180 a year. It's one of the most ludicrous value propositions I've ever come across.
I couldn't agree more. And you guys listening out there, I watch it myself. I have a lot of my friends go on there. I try to share it whenever I'm on, maybe once a month or something like that. I'm a huge fan. I love what you're doing. I think it's great in terms of the financial content that I see out there. I think it's incredibly weak. So I think Real Vision definitely stands out from the rest. So I'm very impressed, Raoul. Kudos to you.
I appreciate it, my friend. I do appreciate it.
And for you guys, again, Raoul Pal, founder and CEO of Global Macro Investor and Real Vision Group. Raoul, thanks for coming.
Good. And you can always find me on Twitter. I engage, as you know, like you do. JC, I engage with people all the time. It's at Raoul, Raoul GMI, which is short for Global Macro Investor, at Raoul GMI. And, I'm happy to be part of the debate. You can see some of my thinking on that and get involved.
Yep, we'll have all those details on the show notes so you guys can check it out there, and reach out to Raoul and tell him you say hi.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.